Hello again, everyone, and welcome to session number 6 of NZX's Virtual Global Dairy Seminar for 2020, as sponsored by StoneX Interfood and Global Dairy Trade. My name is Nick Morris, and I'm the Head of Derivatives at NZX. For this session, I'll be opening with an update on the NZX dairy derivatives markets, with special guest William Chin from SGX dropping in to say a few words about the recent announcement around the potential for an NZX-SGX dairy partnership. This is ahead of the Capital Economics Asia update, which looks very insightful. So we're nearly 10 years to the day since NZX launched its dairy derivatives market in October 2010, with the first trade of whole milk powder futures being completed. And the market is now an active and vibrant market with 8 listed contracts in both US and New Zealand dollars. Some highlights from 2020 so far have been the continued growth in the dairy complex, in particular in open interest, as more commercial hedges have joined the market. In August, we reached an open interest record of close to 90,000 lots, while the milk price contract suite had another year of breaking open interest records at above 20,000 lots. Another positive data point so far in 2020 has been the increase in active end users, which are up over 30% year to date. And this is a factor of more customers accessing the market to manage their price risk, and is a testament to the work that the whole market, including our brokers and advisors, are putting in to grow the understanding and use of these risk management tools. So these new trading records have been reached in the face of what has been a continuation of range trading in whole milk powder, despite the period of volatility and uncertainty brought about by COVID. Whole milk powder has been trading in a $2,500 to $3,500-ish range for nearly 3 years, due to balanced markets and a lack of major supply chain disruptions. But even at these lower levels of volatility, risk management remains a priority for the dairy industry, and the risk for future volatility remains to the upside. In terms of the split of liquidity, in 2018, NZX extended trading hours into the Asian afternoon and European morning, and last year shifted the open forward from 2 AM to 7 AM New Zealand time. So this left us with a 15-hour market, and since then we've seen the vast majority of volume being traded in the Asian session from midday New Zealand time onwards. And just shy of 60% of the volumes being traded are now in the extended Asia and EU session between 4 and 10 PM New Zealand time. In 2020, the milk price market remained the fastest growing of NZX's dairy products, trading an average of 80 lots daily, or just shy of 500,000 kilograms of milk solids per day. And overall volumes are up 31% year to date. So volumes traded this year are on track to be over 120 million kilograms of milk solids for the year, which is roughly equivalent to the annual milk intake of New Zealand's second largest dairy processor. So we're very happy with the progress of this market and see lots of potential growth in the future. Interestingly, just 1 hour ago, we ticked over full year 2019 volumes for the milk price market of 16,400 lots. As mentioned earlier, the market is now 10 years old, is now at a stage of doing over 350,000 lots a year of traded volumes, despite the historically subdued volatility experienced over the past 3 years. To enable a platform to scale up market liquidity for what are global dairy contracts, NZX yesterday announced the signing of a non-binding heads of agreement with SGX to explore a dairy partnership that would see the listing of the NZX dairy contracts on SGX's trading and clearing platforms. The proposed structure would see NZX bring its dairy product development expertise and client relationships while leveraging SGX's global market connectivity, Asian presence, and international distribution to scale growth and liquidity in the trading of these dairy derivatives. The intent of the partnership opportunity is to build liquidity faster in the NZX dairy contracts under a long-term partnership structure with both exchanges actively incentivized to grow the contracts to maturity. So we're excited to explore this potential partnership with SGX for the future development of liquidity in the NZX dairy. And on that note, I'd like to introduce William Chin, SGX's Head of Commodity Derivatives, to make a few words.
Good morning, afternoon, evening, wherever you may be. And thanks for the introduction, Nick, and the opportunity to share our thoughts on yesterday's announcement regarding the intent to collaborate in the dairy space. I have to say this is a little bit like meeting the family. Some of you may be less familiar with the SGX, so maybe let me take a couple of minutes to share our DNA and explain what this potential partnership means. I do want to start off by saying that this is hugely exciting for us, right? The structure and the outlook of both exchanges is actually rather similar. We have to contend with about the same population size, with no deep, big hinterland for growth, which means a constant reassessment of existential opportunities. Size-wise, Singapore is, well, clearly much smaller, about the size of Lake Taupo. In fact, even smaller if you take out land reclamation work that started in 1965. But similar to the NZX, the SGX serves the equity and the debt capital market needs of companies, with a sizable derivatives offering focused on providing international access to global markets. Now, within the FX space, we have built key regional liquidity pools in both the offshore Chinese and also the Indian currency markets. In the past decade, we have built a strong commodities trading ecosystem here in Singapore, and we have established key product pillars in ferrous, in shipping, in power, in petrochemicals complex. Now, some of you undoubtedly will know of, or you trade our iron ore contract, which saw an 80% CAGR growth in the past decade, off the back of strong demand for investment exposure to Asian growth and the consumption story. But less known is that the lineage of the SGX Commodities franchise is actually rooted in the agricultural space, right? Starting with the rubber contracts that were born out of SICOM, or the old Singapore Commodity Exchange in the 1960s that we acquired in a decade ago, and today serves as the global price reference for the international rubber trade. Now, the exchange game is built upon the strong partnership in delivering value to clients, right? And by that, I mean robust and credible price discovery and market connectivity. NZX is a natural partner for us. The dairy derivatives are a global market benchmark, sitting on the trajectory of what we see as one of the world's fastest growing regions, which in many ways is an understatement in the world today, where market contractions are showing up in many spots. There is an aligned vision underpinning this partnership, right? That ultimately strong growth opportunities are for the making when we bring together a few things. Number one, strong support from everyone here in the dairy ecosystem. Number two, powered by NZX dairy product expertise. Number three, built upon what we see or what we think to be SGX infrastructural reach and distribution strength, which will enhance, hopefully, piping and connectivity to put dairy derivatives onto the radar of both regional and global participants. Now, it's lunchtime here. I think I've waffled on for way too long. I'm going to stop now, but watch this space. There's a lot of work that both the NZX colleagues and ourselves need to do to make sure that this is something which will be positively accretive for the industry. And we are very committed to see if we can actually make this work. Stay safe, and I look forward to meeting all of you in person. Thanks, Nick.
Thanks for that, Will. So we'll now move on to the main event of the webinar. In today's session, we have Julian Evans-Pritchard. Julian is a senior China economist at Capital Economics based in Singapore. Julian speaks and reads Chinese and previously worked as a translator for Caixin, one of China's leading finance magazines. And I'm hoping I got that somewhat correct in the pronunciation. Julian holds an undergraduate degree in mathematics and economics from the University of York, and Capital Economics are one of the world's leading independent macroeconomic forecasters, providing actionable coverage of the global economy and markets. Their award-winning range of services include comprehensive data and analysis about China's economic rise, taking in its demand impact on commodities and financial markets, as well as the macroeconomic health of its trading partners. So today, Julian will be giving us a macroeconomic update on China and Southeast Asia, with a focus on how they are rebounding after the 2020 COVID outbreak. So just before I pass over to Julian, if you haven't already, please make sure to download the event app to take advantage of our networking features, access to Q&A and live polls, as well as the recordings. So a link to the web version can be found in the chat box of the GoToWebinar now. If you have any questions for Julian today, please submit these through the app. We'll try to get through as many questions as possible. Questions can also be voted up or liked if you're a Facebooker. So if there is a question you'd like to be asked, make sure to get voting. Attendees have been muted, but this shouldn't impact you hearing us. If you're having trouble, please see the troubleshooting on the left of your screen. We'll also be sending out a recording afterwards so you can rewatch anything you miss. Lastly, throughout today's session, we'll also be running some polls relating to today's topic, somewhat relating to today's topic. See today's poll below. So, which dairy ingredient will be the fastest growing in the next 10 years? And we've got skim, whey, whole milk powder, butter AMF, or other. Looks like skim's leading already. We'll cover the results at the end of the session. To submit your responses, go into the live Q&A and poll section of the web or mobile app. So that's it for the housekeeping. I'll now pass to Julian to begin the session. Over to you.
Thanks very much, Nick, for the introduction. It's a pleasure to be speaking with you all today. Let me just get my slides up and make sure that you can all see them. Is that okay?
Working.
Working, okay, great. So yeah, so my aim today is basically just to give a brief update of how Asia's performing economically and what to expect going forward. Now, obviously, there's quite a lot of ground to cover, so it's going to be quite top down, but if you do have questions on more specific topics, hopefully there'll be time in the Q&A to address those. Now, I'll start by sort of giving the big picture of how Asia's rebound stacks up, both compared to other regions, but also between countries within Asia. Then I'll discuss some of the key factors behind these country divergences, which are going to be very important for framing the outlook for the next couple of years. Finally, I'll discuss the implications for capital flows in markets and give some thoughts on US-China decoupling and the implications for the region. So just to begin with, for the very top-down picture, you can see that emerging Asia, which is what we define as Asia-Pacific, excluding Japan, Australia, and New Zealand, had the earliest downturn in Q1, largely because the virus originated in China, but since then has seen the strongest recovery globally. Now, obviously, Asia is a very, very diverse region, and so these aggregates mask a lot of variation between countries. And this chart shows within Asia the performance of different countries. I ranked them by our estimates for Q3 growth. Obviously, we don't have Q3 GDP figures yet, but in most cases, we have a pretty good idea of what they're going to be. For China, this is using our in-house measure of GDP growth rather than the official figures. But even on that measure, you can see that China has seen the fastest recovery and is the fastest growing country in the region. But I think we'll go through some of the individual countries later, but I think the key takeaway at the moment from this chart is just that there's been a huge amount of variation within Asia. China and the Asian tigers are among the best performing in the world. They've already returned to positive growth in most cases. But on the other side, you have the Philippines and India, which have seen some of the largest contractions globally of anywhere. So there's a huge amount of variation between different countries, which suggests that country-specific factors are very important at the moment and will be key to the outlook. So I'm going to spend quite a bit of time discussing those country-specific factors. But before I do so, I want to just talk briefly about the sort of universal drivers and the global backdrop, if you will. In terms of the global backdrop, the key thing is really the pace of economic recovery. But given the ongoing pandemic, a lot of that hinges on the coronavirus situation. Now, we're obviously not epidemiologists. We can't predict exactly how things will play out on the virus front. But our assumption is that going forward, coronavirus is going to remain a constraint. Restrictions are only going to be lifted gradually. As the past few weeks have shown, if you don't fully contain the virus, it has a tendency to flare up again. And we think that even if we do get a vaccine next year, it will probably take a while for that to be rolled out and for the systems to be in place to sort of reopen things even with a vaccine. So COVID-19 is going to remain a headwind. There's probably also going to be some withdrawal of fiscal support over the coming quarters, and that will be a headwind. That said, we still think the global recovery will probably continue, just at a slower pace. And in particular, I think even with the virus situation in the background, what we're seeing is that the health response is improving. Governments are getting better at imposing targeted restrictions. And also firms and households are getting better at adapting to the new normal. One chart that sort of helps to highlight that is just to look at the global virus situation. You can see that actually we're very much still in the first wave globally, despite talk of second and third waves in individual countries. We haven't really contained the virus. Obviously, part of the increase in new infections is just due to increased testing, but if you look at the deaths, they've also remained pretty elevated. And yet, despite that, we have seen a fairly strong recovery, economic recovery already in many places, and the global economy as a whole is already on the mend. So I think even if the virus continues in the background, that doesn't necessarily prevent a further recovery. This chart sort of highlights that even though a lot of the restrictions on households and firms remain in place, we've continued to see an improvement in some of the mobility high frequency activity trackers. Also, what we've seen is less and less of a connection between some of these mobility trackers and actually the hard economic data. So even though activity on some of these trackers still remains pretty weak, in many cases, a lot of that activity has simply shifted online, or through shifts such as work from home, that has been mitigated in terms of its impact on economic activity. That's particularly apparent in the retail space. Retail sales in major developed markets are already back to where they were pre-virus. They've rebounded very strongly. That's partly thanks to strong fiscal support and transfers to households, but it's also because retailers have adapted more to online, and also we've seen a shift in household consumption away from services towards goods. As a result of the relatively strong rebound in goods consumption and also fairly resilient property markets, construction seems to be rebounding pretty strongly as well. For example, home builders in the US are the most upbeat they've been for years. So those two factors are driving a pretty strong recovery in industrial output, and it looks like that will probably continue. Also, it seems unlikely that future restrictions that are put in place to deal with future flare-ups in the virus will be imposed on factories. What we've seen more recently is that, as I said, governments have become better at targeting higher risk activities and not imposing restrictions on areas such as manufacturing. So there's less of a risk of those sort of kinds of restrictions coming back over the next year or so. So it's really a very sort of skewed recovery. We're seeing a strong recovery in retail, in goods. We're likely to see quite a strong recovery in industrial production. It's really the service sector where the virus is going to remain a major constraint, and particularly areas, as you can imagine, like hospitality, catering, entertainment, that are going to continue to suffer the impact of either government restrictions, or even in the absence of government restrictions, consumer caution, as long as the virus remains a threat. Now, that skew in the recovery globally has important implications for the exports of Asian economies, which I'll discuss in a bit. But I think broadly speaking, the country level drivers, which are driving most of the relative performance within Asian economies, broadly fit into three categories. So the domestic coronavirus situation. In most cases, Asian countries have handled the virus very well, but there are a few countries where that's not the case, and I'll discuss that in a bit. The scale of policy stimulus is an obvious one. Generally, policy has been pretty supportive within Asia. I think perhaps the most interesting one is the composition of net exports. Obviously, we've seen a very sharp drop in oil prices as a result of coronavirus, and that's generally benefited Asian economies because nearly all countries in the region are net oil importers, with the exception of Malaysia. Reliance on foreign tourists, on the other hand, has been a negative for many countries in Asia. But there are a couple that stand out as particularly vulnerable, which we'll discuss in a bit. But perhaps most interesting of all has been how resilient the demand for certain Asian exports have been. So I think it comes back to the point earlier about retail sales rebounding very, very strongly in developed markets, and that's supported very strong demand for things like electronics is the one that stands out, but also goods such as furniture, toy sales, consumer goods that, where sales have held up relatively well even amid restrictions in developed markets. So this just shows the sort of how the Asian economies have coped with the virus. In general, you can see that the blue bars, all the Asian countries on the right, have had far fewer deaths than in the major developed markets. Within Asia, the countries that stand out in particular are Indonesia, Philippines, and India. And those are the countries where there's going to be the largest drags on activity as a result of both continued restrictions because the virus has not been brought under control, but also, like I said, consumer caution and just general weakness in activity. Tourism, it has been particularly weak in Asia, even compared to other regions. This shows arrivals into Thailand's Bangkok's airport, which is used to be one of the busiest airports in the world, and even by mid-September there were hardly any tourist arrivals. That's actually somewhat in contrast to a lot of the rest of the world. So, for example, in Europe, less than 20% of countries in Europe have borders that remain completely closed off to tourists, whereas in Asia, over 60% of borders are still closed off to tourists. So Asia has been particularly hard hit on the tourism front, and that's partly due to the way in which they've handled the virus. It's a lot harder to open up your borders when you've fully contained the virus, and you're concerned about the impact of foreign tourists bringing in the virus and reversing your hard-won gains in containing the virus. So that's going to be a continued problem for Asia. We are seeing signs that there's going to be some opening within countries in Asia that have contained the virus well, but it will be difficult for Asian countries to open up to the broader world and Europe and the US as long as the virus remains widespread in those countries. On the trade front, as I mentioned, exports stand out. Electronics exports stand out as particularly strong recently, and so countries that have a higher skew in their export baskets towards electronics and towards consumer goods are generally doing better and will probably continue to do better in the near term. And on the policy front, we've had a pretty aggressive policy response in Asia, at least on the monetary side. The most aggressive easing cycle, for a long time, even more aggressive than during the global financial crisis. And in many countries, because rates are not at the zero lower bound yet, there's still room to ease policy further if the recovery disappoints. On the fiscal side, generally the fiscal response has been good. There's a greater diversity in fiscal responses, and there are a few countries that don't seem to be doing enough. But generally, both on monetary and fiscal policy, we've seen quite a strong response in Asian economies that puts them in good stead in terms of their recoveries. So what does this all mean for the outlook for Asia going forward? Well, I think it generally means that the outlook is brighter than elsewhere. Most of these country level drivers they work in Asia's favor. The better management of coronavirus means that domestic activity can generally rebound more strongly. Their net exports are less exposed to the pandemic. They don't really export oil. Only a few countries are very heavily exposed to tourism. Most of Asian exports are consumer goods, where demand has held up relatively well. And in terms of policy room, Asian countries have generally had more space to cut interest rates than developed markets, and they've also had generally more space to run larger fiscal deficits than many other emerging markets, which have greater concerns over their debt sustainability, countries in Latin America, for example. But I think, as we've seen that the pace of the rebound so far has varied significantly, I think that's going to remain the case going forward. So I'm going to discuss a little bit some of the specific countries here, but we think generally China, Taiwan, and Vietnam are leading the recovery, and that Indonesia, Philippines, and Thailand will continue to bring up the rear. In terms of China, basically everything has gone in its favor pretty much since the coronavirus outbreak. It's contained it very rapidly. Its exporters make what the world needs right now, not just consumer goods, but it's been able to pivot very strongly into producing things like face masks and medical equipment, which has been in very strong demand. Its import bill has been slashed by lower oil prices, and it's one of the largest net importers of tourism in the region. And so actually the collapse in international tourism has been a net positive for China's growth, because some of that spending will now take place domestically. And probably most importantly of all, it's had a very, very effective policy stimulus response. So as I mentioned earlier, we have our own in-house measure of growth in China, which we call the China Activity Proxy. You can see that it had a much sharper, pointed to a much sharper slowdown earlier in the year, but has since rebounded very sharply, similar story to what's on the official figures in more recent months. And actually now on our measure, the growth rate is back to pre-virus levels, which is a major achievement in such a short time. That's not yet the case on the official figures, but that's not entirely an apples to apple comparison, because in previous years, official GDP growth was being constrained by official growth targets, which prevented Statistics Bureau from publishing figures that were lower than those targets. Whereas this year they opted not to set an annual growth target, which has given the Statistics Bureau a little bit more leeway to publish more plausible and lower figures. So I think the message here really is that most of the, if not all of the downturn in China's economy has already reversed. Now, that's been partly driven by very strong exports, particularly in some of those categories I mentioned earlier, furniture, electronics, and textiles have been boosted in particular by face masks. There's no signs of that very strong export rebound slowing down. The export order components of the manufacturing PMIs just recently hit a 10-year high. So it seems like that the broader recovery in global demand is also now boosting Chinese exports more generally. And coupled with the decline in China's import bill and also the decline in the services deficit, as a result, we've seen a very strong improvement in China's external position. The current account surplus surged in the second quarter and looks to remain very elevated in the third quarter. And that's obviously been a key prop for the Chinese economy. The other key driver has been the very sharp rebound in investment, led initially at least by real estate and infrastructure. On the infrastructure side, very strong fiscal stimulus has helped to boost that significantly. On the real estate side, so far, property prices and sales have remained pretty resilient amid the pandemic, although we do have some concerns that some, the property market faces headwinds from some new tighter restrictions on borrowing among real estate developers. So there are some downside risks to real estate investments, but generally we think going forward, investment will remain very strong. The big jump in credit growth this year, you can see from the blue line, is only being pared back very slowly, and so very strong lending will probably remain a key prop for investment going forward. And in particular, a lot of this borrowing has been driven by local governments, which were given much higher borrowing quotas for this year, and they're actually struggling to spend the money fast enough. This chart here shows the black bar shows the increase in their net borrowing already this year, or at least up until August. And the blue bar shows the deficit. Usually, local governments in China typically spend the bulk of the budgeted funds. There are usually requirements from above, from central authorities to spend all of the funds before the end of the year. So I think the implication of this in the near term, given the strong borrowing, but the fact that spending hasn't kept up, is that we could see a renewed flurry of fiscal spending in the final months of the year, and that's probably going to continue to shore up infrastructure investment in particular. The one area of China's economy that's lagged has been consumption. That was partly because a slowdown in incomes and an increase in unemployment in the first quarter, but actually the bulk of the slowdown in consumption and weakness in consumption has been due to a very elevated savings rate, and that savings rate remained very high in the second quarter. But our view is that the key factors behind this jump in the savings rate were uncertainty over the virus, and also in particular uncertainty over the labour market and employment prospects. At the peak of the downturn, a significant chunk of urban workers, particularly migrants, were unemployed. You had almost a third of migrants without jobs. That excess labour force has been very quickly reabsorbed, partly because of the strength of the construction sector. So by the end of the second quarter, less than 5% of migrant workers were jobless, and the broader unemployment rate had reversed half of its rise. So I think that given the continued strength in the economy since then, it seems very likely that those concerns about the labour market, about the virus, are fading, and consumers will start to open their wallets a bit more. They probably can afford to, given the jump in the savings rate earlier in the year. And that does seem to be what we're starting to see, particularly encouraging retail sales figures out from the holiday earlier this month, which show a sharp acceleration in retail sales earlier this month. And you can see that there's been a shift in favor of online retail that still persisted beyond the lockdowns. Following behind China, we think that Vietnam and the Asian tigers, which is South Korea, Taiwan, Hong Kong, and Singapore, will be the next best performers. Their export baskets are quite similar to China. They're quite resilient in the current environment. They've also been benefiting from US tariffs on China. We have seen some substitution in US imports away from China towards countries in Southeast Asia, particularly Vietnam. All of these countries have managed to contain the virus very well, and the ones that have been hit hardest, particularly because of tourism reliance, so countries like Singapore and Hong Kong, have also been the countries where we've seen the strongest fiscal support, which will go a long way to offsetting some of that weakness. So you can see here that we've seen extraordinarily large fiscal stimulus in Singapore, and it's also been pretty sizable in Hong Kong as well. Following behind the Asian tigers, we think the middle ground will be filled by Malaysia and Indonesia. Malaysia has contained the virus pretty well and has had a pretty strong initial rebound in Q3 following a deep downturn in the second quarter. So on the face of it, Malaysia looks in pretty good position. But I think there are a few risks. First on the politics, what's going on at the moment with Anwar trying to seize power from the current prime minister, potentially create some political uncertainty. And given that we've had a renewed uptick in cases recently, it's not very reassuring that the politicians are focused on political horse trading and less so on the economy. There's also some risk to fiscal support being withdrawn quite prematurely, given that they're close to hitting some of the limits on debt servicing cost as a percent of GDP. And there's also concerns about what will happen if they continue to run very large deficits, given their reliance on external financing and on foreign investors in the bond market. So Malaysia doing fairly well at the moment, but some downside risks, I think. On the other hand, Indonesia has not done nearly as well to contain COVID, but actually, because it didn't have a very harsh lockdown, its economy has held up reasonably well compared to some of the other countries that are still struggling to contain the virus. And also, it's already announced a fiscal package for next year that looks to continue to be pretty supportive. So the policy stance there is a little bit more supportive than in Malaysia. One other sort of positive just to highlight on Indonesia is that just in the past week or so, the government has pushed through a reform package which lowers corporate taxes, relaxes land acquisition rules, and makes it cheaper for firms to lay off workers, which is potentially a really important step in the right direction. The one thing that's been holding back Indonesia for a long time is its very rigid labor market and how costly it is, as you can see from this chart, to fire workers. So it's positive that they're making some improvements in that area, and it probably makes foreign investors a bit more willing to sort of stick with the country, even as they continue to run relatively high deficits over the next couple of years. Next sort of group, that I think will face a more drawn-out recovery than Indonesia and Malaysia is Thailand and Sri Lanka. On the positive side, I mean, they both handled the virus very well, but their reliance on foreign tourism is a major constraint. And their goods exports are also lagging the regions. In Thailand's case, that's because of its high share of car exports in exports. Globally, outside of China, the auto market has not been doing well, presumably because, unlike sales of consumer goods, it's quite hard to shift that online, and obviously the shift to work from home has reduced demand for cars. And in Sri Lanka's case, it's the large textile sector that's not really been performing that well. Textiles are also one of the goods that aren't in very strong demand. The exception being things like face masks and PPE, but Sri Lanka has sort of struggled to pivot to those type of products to the same extent as countries like China and Vietnam have. So this chart just highlighting, the very high share of tourism in Sri Lanka and Thailand's export baskets. And given that tourism is probably going to be the last thing to recover globally, that's going to remain a constraint on their recoveries. Finally, the Philippines and India are probably going to have the weakest recoveries. Unfortunately, both have failed to contain the virus, still struggling with it, even after having very long and disruptive lockdowns. In many cases, the restrictions they put in place were not very well thought out, causing economic damage without really improving the health outcomes. They're also among the countries which have had the smallest stimulus response, which is not great given that they're the countries with the biggest hit to demand. And I think the longer that they remain in very weak recoveries, there's a higher risk of sort of some hit to the supply side from labour market scarring, which could weaken the recovery even further out. So you can see from this chart that activity, mobility in India and Philippines has generally remained much weaker than elsewhere in the region due to those continued restrictions and pretty harsh restrictions in many cases. So this is usually the point of the presentation where I put up a slide of our GDP growth forecast for different countries, but that's not very helpful at the moment. One problem is that the countries which had the deepest downturns earlier this year are also likely to have the highest annual growth next year because of base effects. So we think it's actually more helpful to think in terms of where countries will stand relative to their pre-virus growth path by the end of next year. You can see that this kind of roughly lines up with the different groupings that I discussed earlier. So China and Hong Kong. Hong Kong is somewhat of a special case because of its economy was already very weak from the protests. But generally, China and the Asian tigers in Vietnam leading the way, Malaysia and Indonesia in the middle, and then some of the laggards, the countries that are more reliant on tourism or struggling to contain the virus. In terms of the implications for capital flows and for markets, I think on the whole, the outlook is brighter than elsewhere, and that will support FDI and portfolio inflows into the region. In particular, yields on a lot of sovereign Asian bonds are quite attractive given the credit ratings and the risk-return trade-off. In particular, Chinese government bonds, relative to other risk-free assets, look very attractive. Asian equity markets are probably going to continue to benefit from stronger earnings and outperform their developed market peers. And we think that the capital flows into the region will put upwards pressure on Asian currencies. In particular, I think the renminbi is one where we see a potential for quite strong gains over the near term. You can see that ever since the Fed started cutting rates in 2019, the yield spread between the two countries has pointed towards renminbi appreciation. I think the issue in 2019 was that because of China's slowdown and because of the trade war, there was a lot of uncertainty and that held down the currency. A lot of that is now easing. Generally, China, like I said, is going to have a stronger rebound than the rest of the world. Its external position has also improved dramatically. And as this chart shows, its yields are very attractive by global standards. So we see the renminbi going to 6.3 by the end of next year. And that's probably going to lift a lot of boats in Asia in terms of other Asian currencies. So you can see that Asian currencies typically, particularly the Asian tigers, have a relatively high correlation with the renminbi. And also more generally, we think that a global environment in which the global economy is recovering, appetite for risky assets is increasing, points towards a weaker US dollar and stronger EM currencies. So just to finish up with some thoughts on sort of US-China decoupling, I think that there are winners and losers within Asia. One thing that's quite interesting about the trade war and what we've seen so far is that it hasn't really encouraged much repatriation of production to developed markets. Instead, it seems to be encouraging shifts in production within Asia. So obviously, that benefits some countries and helps to offset the damage to China. And I think it's important to note that, as the focus has shifted from tariffs to security and tech, it's become less damaging economically in the near term. So at this stage, China's linkages with the rest of the world are still predominantly through trade, which is why tariffs had a big impact on markets and on economies. A lot of the more recent measures that we've seen coming out of the US targeted at China, they're going to matter over the medium term in terms of China's ability to rise up the value chain and the shape of the region politically, but has a less of an immediate economic impact. And so that's one reason why markets have not been responding as strongly to some of the recent moves as they were during the trade war. In terms of how US-China decoupling is likely to evolve after the election, our view is that probably whoever wins doesn't change a great deal. I think it's very difficult for Biden to significantly reverse course on Trump's China policies. There's obviously very broad bipartisan support for getting tough on China, and also the Democratic Party has, since the Obama era, very much moved towards the left on trade. So it's quite hard to imagine a situation in which Biden can row back a lot of the tariffs on China without significant concessions from the Chinese side. But I do think one area where we might see some difference is in the approach towards US allies in Asia. Trump's not been very good at sort of creating a united front against China, and has also been very critical of trade policies and currency policies of other countries in the region. Now, I think that they might soften their tone, on countries like Vietnam and Korea, for example, and just sort of turn a blind eye to some of those discretions on trade, just in order to focus more on the China threat. I do think, though, that we shouldn't completely ignore the risk from Trump's transition period, particularly if he starts to blame China and blame the coronavirus for his election loss, assuming he does lose. There's a risk that he could potentially, for example, pull out of the phase 1 trade deal during his transition period, and that could create a lot of market volatility in the region. New Zealand is very much sort of caught in the middle of this US-China decoupling story. It's aligned with China very much on trade, but more so with the US on security and human rights. And so far, it's managed this tension without too many hiccups. But I do think that we shouldn't ignore this risk. Relations with China can be pretty fickle. I mean, Chinese-Sweden relations were fine until suddenly in 2015, Gui Minhai, who was a Hong Kong bookseller with Swedish nationality, suddenly disappeared and then reappeared on the mainland in detention. And that just triggered a significant worsening in relations between those two countries. We've seen a similar thing with China and Canada over the Huawei CFO case. So relations could potentially take a sudden turn for the worst. And the risk for New Zealand is that Beijing often hits harder against smaller countries than large countries, just because it feels it has less to lose in doing so. I think the one sort of factor that might help protect dairy exports in particular is if you look at the Chinese approach to Australia, for example, they've come down very hard on Australian exports for which they can source those products elsewhere. So we've seen restrictions on Australian wine, beef, coal, but we haven't seen restrictions on iron ore simply because China is so reliant on Australian iron ore. That might also be the case for dairy. Obviously, a lot of China's dairy comes from New Zealand, so that might help protect New Zealand dairy exports to some extent, even if relations do deteriorate. So with that, I'll end there and open up to questions. Sorry for going over time a little bit.
Yeah, thanks for that, Julian. We'll now move to the Q&A. Remember to submit your questions via the event app and vote for the questions if you want to push them to the top. So top of the list, we've got the impacts of climate change. How do you expect that to impact Asian nations in the next 5 to 10 years? And which countries are most exposed to its effect? And then what might it mean for demand for imported food goods?
Yeah, that's a good question. So we did some work on this about a year or so ago, the impact of climate change. I think there are two sort of factors to bear in mind. First is sort of how exposed countries are geographically, so the extent to which, for example, the portion of the population living near to sea level, those sort of metrics. And there are a couple that stand out as particularly exposed. I think Bangladesh being the one that we're most concerned about. The other factor in all this is how wealthy those countries are. Generally, even countries that are somewhat exposed from a sort of purely climatic geographic perspective, if they're wealthy enough, then they can generally go a long way towards mitigating the impact of climate change. So, for example, in Singapore or even in China, we think that by the time climate change becomes a significant concern, they'll be wealthy enough to mitigate a lot of the impact. So in terms of large, sort of sizable macro impacts, it's really the poorer, less developed countries that are going to suffer the most. I must admit, I don't know exactly the details of our forecast on that, but I do know that within Asia, Bangladesh is where we're most concerned.
And countries like Jakarta, cities, I guess, like Jakarta are expected to be able to manage some of the impacts they're experiencing.
Yeah, I think for the most part, cities, well, if they have the funds, they can manage, rises in sea level, for example. It's poorer rural areas that are near sea level. That's where there's the biggest concern. The other risk that's been flagged up is simply higher incidences of disease, which we did this work prior to COVID, but it's interesting that the scientific consensus is that we could see higher rates of disease as a result of climate change, and that's going to hit the countries which have the worst health systems. We've already seen how much of a difference the health response and the quality of the healthcare system can make when you have these kind of disease outbreaks.
Yeah, so prior to COVID, obviously, there was a kind of strategic intent from China to move to a more consumption-led model for their economy. That's obviously been thrown on its head a bit, as have most governments' plans for their economies. But what do you think the impact of this will be on their long-term strategy? They're probably now leaning more on the investment and export levers. What does that mean for debt levels, for example, I guess, and the outlook for China?
Yeah, so in the short term, we've seen a very big shift back towards investment. The consumption share of GDP in the first half of the year fell to sort of the lowest since just after the global financial crisis. So you've had almost a decade of rebalancing being undone in a very short space of time. Now, as I kind of discussed, I don't think that that's permanent. I think a lot of it is just the temporary weakness in consumption and the way that they've decided to stimulate the economy, which is primarily through investment. But I think that over the next couple of years, a lot of that imbalance will reverse. But they are still struggling to find a way to to boost consumption in the long run, and it's partly to do with the way the Chinese state operates and the way it supports the growth is primarily still for investment, and I don't think that that's really shifting. If you look at their priorities at the moment, actually they're doubling down on a lot of their state-led investment plans. That's partly to do with the coronavirus situation, but a lot of it is to do with this feeling of being confronted globally. They need to reduce their reliance on foreign technology, pour more money into investing in domestic innovation. So, I'm of the view that the Chinese economy will still gradually become more consumption driven. That has been the trend over the past decade or so. But I don't think that they're really taking the steps that are needed to accelerate that trend significantly. It's still very much a situation where both consumption and investment are slowing over the long run. It's just that investment is slowing a little bit faster than consumption, which is a form of rebalancing, but it's not really the rebalancing that sort of a lot of people were hoping for when they first began talking about the shift towards consumption almost a decade ago.
Thanks. And you can probably see the question there around foreign policy, a bit of a loaded one, regarding their military expansion, Taiwan and South China Sea. Does that pose a credible threat to economic stability?
So I think it's a growing risk, but it still seems unlikely, in my view, that we'll see, a military conflict. I think generally speaking, China's fairly pragmatic about the issue. They're trying to nudge things gradually towards reunification with Taiwan, but I think that we're still a long way from them, in my view, being willing to take that kind of risk to launch an invasion. In terms of the South China Sea as well, I do think we are seeing a bit more pushback from Southeast Asian nations on Chinese expansion in the South China Sea. And I do think we'll get a bit more of a coherent strategy from the US to address some of that as well. But I still think we're in the situation where both sides are just trying to see how far they can push things, but no side really wants a conflict. You can see that with, for example, the recent flare-up in tensions between China and India. That could have gone very wrong. Both sides initially began to sort of play up the nationalist line in response to the skirmishes on the border there. But the Chinese side seemed to have quickly, clamped down on that kind of nationalist narrative and taken a more pragmatic approach to sort of dampen down tensions along that border. And I think that even if we do see flare-ups, geopolitical flare-ups elsewhere, China will probably pursue that strategy of trying to keep those situations from flaring up into a broader conflict.
Right, and I think we've got 1 minute left for the last question. Again, pretty loaded, but you did mention the debt levels of some of the mid to smaller size Asian nations there in Southeast Asia. Any risk of potential Asian crisis, some of the 90s arising due to some of the debt levels that they're carrying?
I think generally the risks are much lower. Debt levels are generally lower, and crucially, policymaking has improved, generally improved significantly. There are a few countries where, there are some concerns, Malaysia and Indonesia in particular, just given the high level of foreign currency debt and reliance on foreign creditors. But I think that on the whole, what we've seen recently is actually when we had the initial coronavirus shock, there was significant concerns that we could see major capital outflows from these countries and very, very significant currency depreciations. And that has not really been the case. And actually, capital has proven a bit more sticky than was initially feared. So I do think that given that they've managed to survive this crisis, the near-term risks are probably not too significant. I actually think that China is the country that probably we should be the most concerned about in terms of debt risks. I'm a little bit concerned about the crackdown on property developers there at the moment, because while it makes sense in the long run, if this crackdown is successful, if they rein in these companies, it will improve financial stability, but only if they can do so in a way that doesn't trigger a broader systemic crisis. And they've struggled to do that in the past. So, for example, a couple of years ago, when they tried to allow haircuts for a regional Chinese bank, that caused significant strains in the interbank market, which eventually caused them to reverse course. I still think it's unlikely that we'd get a debt crisis in China, but actually the risks of that happening are higher when the economy is doing well, when policymakers are more confident that they can step back, and it's when policymakers decide that they want to step back is when there's a risk of something going wrong.
Thanks. Quick update on the poll. Obviously, Wei is the general expectation to be the fastest growing in the next 10 years, followed somewhat closely by Skim, milk powder. So a quick reminder of what's on tomorrow. If you haven't registered, make sure you do via our event app. Tomorrow we have 5 more sessions for what is the final day of the Global Dairy Seminar. I'd just like to thank everyone for joining us, and a special thanks to Julian again. We really appreciate you giving your time to share your valuable insights. Details on how to access complimentary reports from Capital Economics will be out this evening, and we look forward to seeing you all tomorrow.
Thanks a lot for having me.
Thanks, Julian.
Thanks.